Balancing risk and reward is a fundamental aspect of successful investing. Achieving the right balance involves understanding your risk tolerance, setting clear investment goals, and implementing a strategy that aligns with both. Here's a comprehensive guide on how to strike this balance and optimize your investment portfolio. Understanding risk tolerance. Risk tolerance is a critical factor in determining how much risk you're willing and able to take with your investments. It's influenced by several factors, including your financial goals, investment time horizon, income stability, and personal comfort level with market fluctuations. To assess your risk tolerance, evaluate your financial situation, consider your current financial status, including your income, expenses, savings, and existing investments. A stable financial situation with a solid emergency fund may allow you to take on more risk compared to someone with less financial security. Define your investment goals. Identify your short-term and long-term goals, such as saving for retirement, purchasing a home, or funding education. Your goals will help determine the appropriate level of risk you can take. Consider your time horizon. The length of time you plan to hold an investment before needing to access the funds affects your risk tolerance. Generally, a longer time horizon allows for greater risk-taking because you have more time to recover from potential market downturns. Assess your emotional comfort. Reflect on how you react to market volatility and potential losses. If market fluctuations cause you significant stress, you might prefer a more conservative approach. Diversification. Spreading out your risk. Diversification is a key strategy for balancing risk and reward. It involves spreading your investments across various asset classes, sectors, and geographic regions to reduce the impact of any single investment's poor performance on your overall portfolio. To diversify effectively, asset allocation. Allocate your investments among different asset classes, such as stocks, bonds, real estate, and cash. Each asset class has its risk-return profile, and combining them can help manage overall risk. Sector diversification. Invest in different industry sectors to mitigate the risk associated with economic downturns in a specific sector. For example, combining investments in technology, healthcare, and consumer goods can provide more stability. Geographic diversification. Consider investing in international markets to reduce the risk associated with a single country's economic performance. Global diversification can also expose you to growth opportunities outside your home country. Investment vehicles. Use various investment vehicles, such as mutual funds, exchange-traded funds, ETFs, and individual stocks or bonds, to achieve diversification. Many mutual funds and ETFs offer built-in diversification across multiple assets. Risk management techniques. Effective risk management involves implementing strategies to mitigate potential losses while aiming for desirable returns. Regular rebalancing. Periodically review and adjust your portfolio to maintain your desired asset allocation. Over time, certain investments may outperform or underperform, leading to an imbalance in your portfolio. Rebalancing helps ensure your portfolio remains aligned with your risk tolerance and goals. Stop-loss orders. Use stop-loss orders to limit potential losses on individual investments. A stop-loss order automatically sells an asset when it reaches a predetermined price, helping to protect your portfolio from significant declines. Hedging. Consider hedging strategies to protect your investments from potential losses. For example, options and futures contracts can provide a way to hedge against adverse price movements in your portfolio. Diversify within asset classes. Even within a single asset class, diversify among different investment options. For instance, within stocks, invest in a mix of large cap, mid cap, and small-cap companies across various industries. Evaluating risk-reward trade-offs. Assessing the risk-reward trade-off involves analyzing the potential returns of an investment relative to its associated risks. Higher potential returns typically come with higher risk, and vice versa. Risk-reward ratios. Calculate risk-reward ratios to evaluate the attractiveness of different investments. For example, the Sharpe ratio measures the risk-adjusted return of an investment, helping you compare the potential returns against the risks taken. Historical performance. Review the historical performance of investments to understand their risk and reward characteristics. However, remember that past performance does not guarantee future results. Scenario analysis. Perform scenario analysis to assess how different market conditions might impact your investments. This analysis helps you understand potential outcomes and prepare for various scenarios. Adjusting based on changing circumstances. Your investment needs and risk tolerance may change over time due to evolving life circumstances or market conditions. It's essential to adapt your strategy accordingly. Life events. Significant life events, such as retirement, buying a home, or starting a family, can impact your risk tolerance and investment goals. Adjust your portfolio to align with your new circumstances. Market conditions. Stay informed about market trends and economic conditions. Adjust your investment strategy based on changes in the financial landscape and your personal financial situation. Review and adapt. Regularly review your investment strategy and make adjustments as needed. Ensure that your portfolio remains aligned with your goals, risk tolerance, and changing circumstances. Balancing risk and reward is an ongoing process that requires careful consideration and continuous management. By understanding your risk tolerance, diversifying your investments, implementing risk management techniques, and adapting to changing circumstances, you can effectively balance risk and reward to achieve your financial goals. Creating a balanced investment strategy. Creating a balanced investment strategy involves designing a plan that aligns with your financial goals, risk tolerance, and investment time horizon. Here's how you can develop and maintain a strategy that effectively balances risk and reward. Defining your investment objectives. Before creating an investment strategy, clearly define your investment objectives. This includes understanding what you want to achieve and the time frame within which you want to accomplish it. Set clear goals. Determine what you are investing for, whether it's retirement, a major purchase, education, or wealth accumulation. Specific goals will guide your investment decisions. Establish time horizons. Identify your investment time horizons for each goal. Short-term goals, less than 5 years, might require a more conservative approach, while long-term goals, more than 10 years, may allow for more aggressive strategies. Determine your risk tolerance. Assess how much risk you are willing to take to achieve your investment goals. Higher risk might be necessary for higher potential returns, but it should match your comfort level. Building your investment portfolio. Once you have defined your objectives, it's time to build a diversified investment portfolio that reflects your goals and risk tolerance. Asset allocation. Allocate your investments among various asset classes such as equities, bonds, real estate, and cash. Each asset class has different risk-return profiles, so balancing them can help manage overall risk. Diversification. Diversify within each asset class by investing in different sectors, industries, and geographic regions. For example, within equities, you might invest in technology, healthcare, and consumer goods across domestic and international markets. Investment vehicles. Choose the appropriate investment vehicles for your portfolio. mutual funds, ETFs, index funds, and individual stocks or bonds each offer different benefits and risks. Implementing and monitoring your strategy. Implementing your strategy involves executing your investment plan, and continuously monitoring its performance. Execution: invest according to your asset allocation plan. Purchase the selected investment vehicles and ensure that your portfolio reflects your desired risk-return profile. Regular monitoring: track your portfolio's performance regularly. Compare it against your goals and benchmarks to ensure it's on track. Look for deviations from your target allocation and make adjustments as needed. Rebalancing: periodically rebalance your portfolio to maintain your desired asset allocation. Over time, some investments may grow faster than others, causing your portfolio to shift away from its intended balance. Adapting to changes: your financial situation, goals, and market conditions can change, necessitating adjustments to your investment strategy. Review financial goals: reassess your financial goals and time horizons periodically. Life events, such as marriage, having children, or retirement, can impact your investment strategy. Adjust risk tolerance: reevaluate your risk tolerance based on changes in your financial situation or personal preferences. As you approach your goals or experience significant life changes, you might need to adjust your risk exposure. Stay informed, keep up to date with market trends, economic conditions, and financial news. Being informed allows you to make timely adjustments to your strategy in response to changing circumstances. Maximizing returns while managing risk. Achieving a balance between maximizing returns and managing risk involves employing various strategies and practices. Long-term investing: focus on long-term investing to ride out market volatility and take advantage of compound growth. Avoid making impulsive decisions based on short-term market fluctuations. Dollar cost averaging: invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps reduce the impact of market volatility and lower the average cost of investments over time. Risk management tools: use risk management tools, such as stop-loss orders, limit orders, and hedging strategies, to protect your investments from significant losses. Tax efficiency: optimize your investment strategy for tax efficiency. Utilize tax-advantaged accounts, such as IRAs and 401ks, and be mindful of the tax implications of buying and selling investments. Evaluating performance and adjusting strategy: regular evaluation and adjustment of your investment strategy are crucial for achieving your financial goals. Performance metrics: use performance metrics, such as total return, risk-adjusted return, and alpha, to assess how well your investments are performing relative to your expectations and benchmarks. Benchmarking: compare your portfolio's performance against relevant benchmarks to evaluate its relative success. Benchmarks provide a standard for measuring performance and can highlight areas for improvement. Strategy reassessment: periodically reassess your investment strategy to ensure it remains aligned with your goals and risk tolerance. Make adjustments as needed to address changes in your financial situation or market conditions. Creating and maintaining a balanced investment strategy requires careful planning, regular monitoring, and adaptability. By defining your objectives, building a diversified portfolio, implementing your strategy, and making necessary adjustments, you can effectively balance risk and reward to achieve your financial goals. Understanding different investment strategies to successfully manage your investment portfolio: it's crucial to understand and implement various investment strategies. Each strategy has its own approach to achieving financial goals, managing risk, and maximizing returns. Here's a detailed exploration of key investment strategies. 1. Growth investing. Growth investing focuses on investing in companies that are expected to grow at an above-average rate compared to other companies. Investors in this strategy seek capital appreciation through investments in companies with high potential for future growth. Characteristics: growth stocks typically have higher price-to-earnings (P/E) ratios and may reinvest earnings into the business rather than paying dividends. Examples: technology and biotech companies are often associated with growth investing. Considerations: this strategy involves higher risk due to the potential volatility of growth stocks. Investors should be prepared for fluctuations in stock prices and should have a long-term investment horizon. 2. Value investing. Value investing involves selecting stocks that appear to be undervalued relative to their intrinsic value. Investors using this strategy look for bargains in the stock market, focusing on companies with strong fundamentals but low stock prices. Characteristics: value stocks typically have lower P/E ratios and may offer dividends. These stocks are considered undervalued based on metrics like price-to-earnings, price-to-book ratios, and dividend yield. Examples: established companies with consistent earnings and solid financials that are trading below their historical valuation may be considered value stocks. Considerations: this strategy may require patience as it can take time for the market to recognize the true value of undervalued stocks. Investors should be prepared for potential short-term underperformance. 3. Dividend investing. Dividend investing focuses on stocks that pay regular dividends. Investors in this strategy seek income through dividends as well as potential capital appreciation. Characteristics: dividend stocks typically belong to mature companies with a history of stable and consistent dividend payments. These companies may have lower growth potential but offer regular income. Examples: utilities, consumer staples, and established blue-chip companies are often favored for dividend investing. Considerations: while dividend investing can provide steady income, investors should also consider the potential for dividend cuts and the overall stability of the company. 4. Index investing. Index investing involves purchasing a broad market index or a fund that tracks a specific index. This strategy aims to replicate the performance of a market index, such as the S&P 500, rather than trying to outperform it. Characteristics: index funds and exchange-traded funds, ETFs, are commonly used for index investing. These funds provide diversification and have lower management fees compared to actively managed funds. Examples: investing in an S&P 500 index fund or an ETF that tracks the Dow Jones Industrial Average. Considerations: index investing offers broad market exposure and lower costs but may not outperform the market. Investors should be comfortable with market returns and less concerned with selecting individual stocks. 5. Real estate investing. Real estate investing involves purchasing properties to generate rental income, or capital appreciation. This strategy can provide diversification beyond traditional stocks and bonds. Characteristics: investors can buy residential, commercial, or industrial properties. Real estate investments can offer rental income, tax benefits, and potential property value appreciation. Examples: buying rental properties, investing in real estate investment trusts, REITs, or developing properties for resale. Considerations: real estate investing requires significant capital, management, and maintenance. Investors should be prepared for the challenges of property management and market fluctuations. 6. Passive versus active investing. Understanding the difference between passive and active investing is crucial for developing an effective investment strategy. Passive investing, this approach involves buying and holding investments for the long term with minimal trading. Passive investors typically use index funds or ETFs to achieve market returns. Characteristics: lower costs, reduced risk of underperformance compared to active managers, and a focus on long-term gains. Examples: investing in a diversified index fund and holding it for several years. Active investing, this approach involves actively managing investments by buying and selling assets to outperform the market. Active investors use research, analysis, and market timing to achieve higher returns. Characteristics: higher management fees, potential for higher returns, and a focus on short-term market movements. Examples: actively managed mutual funds, stock picking, and frequent trading. 7. Asset allocation. Asset allocation involves distributing investments across various asset classes to balance risk and reward. Proper asset allocation is key to achieving long-term financial goals while managing risk. Characteristics: a well-balanced portfolio typically includes a mix of equities, bonds, real estate, and cash. The allocation should align with your risk tolerance, investment goals, and time horizon. Examples: a conservative portfolio might have a higher allocation to bonds and cash, while an aggressive portfolio might focus more on equities. 8. Dollar cost averaging. Dollar cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps reduce the impact of market volatility. Characteristics: by investing consistently over time, investors can avoid the pitfalls of trying to time the market and benefit from lower average costs. Examples: contributing a set amount to a retirement account each month. 9. Hedging. Hedging involves using financial instruments to protect against potential losses in an investment portfolio. This strategy aims to reduce risk and stabilize returns. Characteristics: common hedging techniques include using options, futures, and other derivatives to offset potential losses. Examples: using put options to protect against declines in stock prices. 10. Long-term versus short-term investing. Understanding the difference between long-term and short-term investing helps tailor your strategy to meet specific goals and manage risk. Long-term investing focuses on holding investments for several years to benefit from compound growth and reduce the impact of market volatility. Characteristics: lower turnover, potential for higher returns, and less concern with short-term market fluctuations. Examples: investing in growth stocks or retirement accounts. Short-term investing involves buying and selling assets over shorter periods to capitalize on market trends and price movements. Characteristics: higher turnover, increased risk, and potential for quicker gains or losses. Examples: day trading or swing trading. Developing a diverse and well-rounded investment strategy involves understanding and implementing various investment strategies. Each approach has its own characteristics, benefits, and risks, and the best strategy for you will depend on your financial goals, risk tolerance, and time horizon. Don't forget to subscribe in the channel and like the video for more contents.